Welcome everyone joining us. My name is Eric. I'm the head of research at the AASB, and I'll be chairing the session today. Now, in recent years, we have heard about Bitcoin, NFTs, Ethereum, the recent collapse of the crypto exchange FTX, and we have heard questions about what they are, how they affected the economy, business models, and investors' decisions. And we have heard many concerns about the accounting implications of the growth of different forms of digital assets. Now, with you today, I'm very happy to be joined by very knowledgeable people in this space, and would like to spend the next hour discussing issues about digital assets. Now, I'm aware that there are many different types of digital assets in the market, but what we are going to focus on in this session are those crypto-related assets or digital assets with blockchain technology. And it's also important to note that we may use terms like crypto assets, digital assets, tokens, and similar terms that may mean or may not mean the same thing in our discussions. But please feel free to ask questions if necessary. Now you can use the Q&A function at any point in time to ask questions, and we'll try to answer as many questions as possible. And we also like to hear your views, so please feel free to comment. Now, before we start, I'd like to quickly say that this forum is to share ideas and perspectives, and the views provided in this session are the views of the presenters and are not necessarily the views of the AASB. So let me first give you a bit of background. The AASB has been monitoring the development of digital assets for a while. For example, in 2016, the AASB published a report about digital currency. It was written by Henry Venter, who is now a partner at Deloitte, and that report was presented and discussed at various international standard setter meetings. In particular, the report provides some helpful conceptual thinking about how cryptocurrency should be accounted for. And then in 2019, the IFRS Interpretation Committee discussed and made some interpretation guidance on how transactions related to the holdings of certain types of cryptocurrencies should be accounted for under the IFRS accounting standards. However, we have still been hearing many concerns about the digital asset space. In particular, there are concerns about the many new forms of digital assets or cryptos being developed in the market, and how these different types of digital assets should be accounted for and reported to meet the needs of the financial statements users. And so internationally, standard setters have been monitoring this topic closely. That includes the AASB. And so the AASB Research Center is now conducting outreach to understand further how prevalent digital assets are in the Australian market and what accounting or reporting issues the stakeholders are having concerns with. Now, this is an important process. Like any standard setting work, research is important to gather sufficient and reliable evidence to make informed standard setting decisions. So today we're going to first hear from our presenter, Associate Professor Andrew Jackson, then followed by panel members who are introduced later. And again, please feel free to ask any questions by using the Q&A function. Now, Andrew, would you like to put your slides up now while I'm introducing you? So Andrew Jackson is an associate professor in the School of Accounting, Auditing and Taxation at UNSW, who has had many years of experience in researching and publishing papers related to financial accounting. He is the editor-in-chief of the Australian Journal of Management. He is the Australian president of the Accounting and Finance Association of Australia and New Zealand, and recently he's been elected as a member of the CAANZ New South Wales Regional Council. So Andrew, I'm going to hand over the presentation to you. Again, audience, feel free to ask any questions in the Q&A function. Thank you.
Thank you, Eric, for that introduction. So as Eric mentioned, I'm going to be talking about and trying to set the scene about what is it that we're talking about with digital assets and what is the current accounting for it. And as an academic, I'd like to veer off and share some of my thoughts from outside of practice about what should the next sort of steps look like from my perspective. Obviously, sitting outside practice, I'm not necessarily aware of a lot of the intricacies within practice, And so this is where the sort of intersection between academia and this outreach by the AASB is really important to get a clear sense of where we should be heading in this area. So in terms of digital assets, the size of the market here is very large. So we're not talking about a niche sort of area anymore. We're not talking about the sort of cryptocurrencies, which used to have the sorts of connotations of the dark web being used here. This is a fairly large and well-used sort of area. The global value back in November 2021 was estimated at around about $3 trillion US. In that same year, about 14% of US adults own digital assets, with an additional 13% planning to purchase in the next year. Now, that is at an individual level. At a corporate level, however, we have had some developments in this space as well. So we've got companies which have started to accept payment in digital currencies. So, and companies like Wikipedia, Microsoft, AT&T have allowed for Bitcoin to pay for services. In September of 2021, El Salvador was the first country which actually made Bitcoin a legal tender. So the arguments within the sort of standard-setting world whereby digital currencies are not legal tender, that doesn't hold weight anymore. We've got at least one country which has moved to make it legal tender. Now, before we move on, it's really important to actually have a definition about what is it that we're talking about. Now, within these sorts of definitions, it's very important to note that, as Eric mentioned earlier, there's not always agreement around these and different terminologies are used. So when I talk about digital assets, what I'm really referring to here is anything that is stored digitally and is uniquely identifiable that organizations can use to realize value. Now, a lot of that uniquely identifiable aspect is where it's going to be verified through through blockchain types of technologies. And this is really the focus of what the AASB appears to be interested in at this point in time. FRAG had a different definition here, whereby they talked about a digital representation of value or contractual rights created, transferred, and stored on some type of distributed ledger technology network, such as the blockchain, and authenticated through cryptocurrency. Now, initially, cryptocurrencies or digital currencies were synonymous with digital assets. But this is no longer valid, with the types of coins and tokens growing exponentially over time. And my expectation is that the sorts of coins and tokens that we have at this point in time are going to be a very small portion of what we see in the coming years as well, as we see more growth in this area. Now, what FRAG really focused on, and the IFRS appeared to focus on early on in this sort of debate, was very much around the idea of cryptocurrencies or digital currencies. But it's a lot broader than that. So what are the different types of digital assets that we do have? Well, as I said, the sort of main one that people think about is going to be the digital currencies. So these are going to be currencies that exist and are traded using this distributed ledger technology. And they pose an alternative to the sorts of fiat currency, except in that they're not going to be issued by a central governing authority. And when we think about value here, value is really derived from the market forces of supply and demand. So where we've got these trading platforms, then this is going to essentially be where value is derived from. Now, these trading platforms are going to be a really important aspect that needs consideration, especially from a regulatory perspective. And I hope that some of the fellow panelists are going to be able to share some sort of views on this area. It's not something I'm going to touch on. So as I said, digital currencies are really have been the main focus of the IFRS and IFRAC. But that's not what digital assets are limited to. It's much broader than that. So we've got things like utility tokens. So they're going to be, again, based on the digital ledger technology and provide the holder the right to attain some underlying utility in the future. Now, while the ownership of these tokens are going to be legitimized using blockchain, the goods or services that they're accessed are going to be also usually based on this digital ledger technology as well. Now, how is value going to be derived from utility tokens? Well, it's going to be derived from the demand of the particular good or service which the token is going to grant the rights to. We then have other types of tokens. So we've got asset-backed tokens, which are essentially digital liquid contracts for ownership of some asset, such as a house, a commodity, artwork, or equity in a company. Here, holders are going to be provided with an interest in an underlying asset, but instead of trading on the underlying asset itself, it's going to be the token which is going to be exchanged. Now, what the digital ledger technology functions here as is a guarantee of ownership of the token, which represents part ownership of an asset. Now, the value here of these asset-backed tokens then is going to be derived from the supply and demand of this underlying asset. Now, it should be noted here, in digital ledger technology, it can get confusing. If you go back to the early 2000s, when there's a lot of work on financial instruments, some of those get really complicated. Thinking back to some of the sorts of instruments that Enron was using. It's the same within this digital asset type space. They can get very complicated here. And so in the case of these asset-backed tokens, it's pretty similar. So it should be noted here that while the token guarantees the holder's ownership of the asset, the actual existence of the asset or the underlying asset cannot actually be assured. So it can get a bit confusing here at times. We then move into things like non-fungible tokens. So these are going to be tokens which are unique digital identifiers that are again going to use this digital ledger technology to legitimize the ownership of a specific item that can either be tangible or non-tangible. Now, the difference between these NFTs and other asset-backed tokens here is in the essence that the underlying asset is going to be non-fungible. So that is, it can't be replaced with another identical asset. Now, the view here of NFTs is that they derive value here because it guarantees authenticity of that underlying asset and because it cannot be exchanged with another asset of the same type. These are unique assets. And then we move into stable coins. And so these stable coins are going to be transferring ownership based on this digital ledger technology with the distinguishing characteristic that its price is going to be pegged. And so we've got three main types of stable coins here. So we've got fiat collateralized, so whereby the coin is backed by a fiat currency. We've got crypto collateralized, so where these are going to be cryptocurrency is going to be backed by another cryptocurrency. And then we've got non-collateralized stable coins. So it's not going to be collateralized to another asset, but it's going to rely on a smart contract to buy or sell the stable coin in order to maintain the supply and keep its price constant. Now, as I mentioned, we do have a warning within these different types here. And so that there's not always agreement over these different classifications and different terminologies are used. So again, this is where some of the complexity comes in with the accounting for digital assets, is in terms of different terminologies often get used, and there's not always agreement over these different types of classifications that we do have. So what is the current accounting treatment? Well, at present, there's no specific accounting standards. And so what firms are required to do is rely on the existing standards that we have, guidance from standard setters, and generally accepted practice. Now, going back to June 2019, the IFRS Interpretation Committee issued an agenda decision for cryptocurrencies. And essentially what their interpretation was is that those cryptocurrencies can be either accounted for under IAS 38, being an intangible asset, or under IAS 2 for inventories. Now, it should be noted here that this interpretation is based on the accounting for cryptocurrencies only. It's not based on other types of digital assets that we do have out there. In the US, the accounting treatment set out by the standard setters appears to be more consistent with an indefinite-lived intangible asset following ASC 350. Now, within the US, there is a rule that inventory must be tangible, and so the decision was made that the intangible standard would not, the inventory standard would not apply since these cryptocurrencies are not tangible. Now, just as a sort of an example here, this is what Tesla reported in their 10Q from March 2022. Now, one thing that I'd like to note here is that compared to what we've got, say, in Australia at the moment, this disclosure in the 10Q is a lot more in-depth than what we see. Now, what we do see, however, is that most of the disclosures in these 10Qs appear to relate back to identification of risks that firms hold. And so having a look at a number of these 10Q sorts of disclosures, it generally has a sort of reporting that we hold and may acquire digital assets that may be subject to volatile market prices, impairment, and unique risks of loss. They do, however, have some other digital holdings, which they do go through and in their note 3 report about this. And the important part to note here is that they are recording these as intangible assets. Now, in a student project that was done with the AASB that I was mentoring a student, we had a look through some accounting treatments that we could identify where firms held these digital assets. And what we found is that largely in the US, they followed through with this sort of guidance whereby the intangible assets was mostly used. In Canada, we had intangible assets and inventory. Germany, intangible assets. The UK, only inventory. Japan, Hong Kong, only intangible assets. In Australia, there is the case of Digital X, the only company which we could identify as reporting holdings with digital assets. Interestingly, what they did is they reported their holdings as being intangible assets, inventory, but also as a financial asset. And indeed, in the US, 3 firms decided on classification as a financial asset as well. So if we think about these accounting treatments, what are the accounting rules that we've got here? Well, under IFRS, with intangibles, we've got initial recognition at cost. Downwards movements are going to be recognized in income. Upwards movements not recognized under the cost move model are going to go through income. Anything more than that is going to be going through OCI. Under inventory, again, we've got initial recognition at cost. Subsequent measurement needs to be following the lower of cost and net realizable value. So downwards movements are going to go through income, but we're not recognizing any upwards movements. But we do have this broker trader exception where all movements are going to be recognized in income. Now, the broker trader exception is largely going to be applying where firms are going to be engaged in the mining of digital assets and then trading on those. Now, for Digital X, and if any company did decide they wanted to go through with financial instruments, then the initial recognition will need to be at cost. Again, downwards movements are going to be recognized in profit. Upwards movements would either need to go through OCI if they're classified as being available for sale, or through profit if they're fair value through profit and loss. Now, the accounting treatment, or what it actually looks like on the income statement with the movements, is going to be fairly similar across them. But we do have the classification types of issues, whereby how you actually classify it is going to provide information to users. So we've got these general issues. We've got the understandability sorts of issue here, whereby firms fail to clearly disclose the constituent parts of their holdings. It's going to make it more difficult for users to actually acquire a complete understanding of the company. With any lack of authoritative guidance, then firms are going to require judgment to be exercised, and we can lead to a lack of comparability. And another big issue here is that the guidance has only been issued for cryptocurrencies. And this is outdated in the sense that we've got all these other types of digital assets where we don't have any guidance from the IFRS or any other sorts of bodies. So what are the potential accounting treatments? Well, we could go with cash potentially for cryptocurrencies. Now, the general argument around this is that cryptocurrencies do not share any of the common characteristics of cash, such as not being legal tender or not being backed by any government or state, and currently not capable of setting prices for goods and services directly. So this comes from the PwC report. Now, to the extent that this argument is still valid or not, may start to become questioned where we've got digital currencies being used for payment, and the case of El Salvador enacting Bitcoin as legal tender. So this idea that cryptocurrencies are not legal tender may not hold weight. The conclusion from PwC, however, that it's not backed by any government or state, or it's not capable of setting prices for goods and services directly, may still hold some weight. And so you need to be really clear about, well, how are these goods or services being, how are prices being set if they're being accepting digital currency for this? Now, we've also got the issue that, well, we know we can see this, there's a lot of volatility in these cryptocurrencies as well. So would any company actually want to elect to use cash for these when it's going to introduce a huge amount of volatility onto their balance sheets? Also, if we think about cryptocurrencies being classified as cash, well, would changes in value then need to be treated in the same manner as changes in a foreign currency would? And I think this is probably going to open a Pandora's box that no one really wants to get involved with. So cash is probably not going to be a viable option that we're looking at here. A potential is financial assets. So from IAS 32, a financial asset is either going to be cash, an equity instrument of another entity, contractual right to receive cash or another financial asset from another entity, contractual right to exchange financial assets or liabilities under certain conditions, or a particular contract that will or may be settled on the equity's own instruments. Now, in the case of security tokens, well, here they do provide the holders the rights to cash, dividends, or another financial instrument. And so potentially financial instruments could be used here under the current definition. There is a question though, are there actually rights to cash flows or not? And this is something that I think there needs to be more debate over and more agreement too before we start heading down this route too prematurely. Now, also we've got these sorts of potential accounting issues that may arise. So depending on the classification, there's going to be inconsistencies in accounting treatment in the absence of any regulatory action. The majority of this is going to be revolving around how do we recognize movements in value above cost. Now, as I mentioned, Depending if we're looking at inventory, intangibles, financial assets, there's going to be differences. We've also got the potential here mainly for understatement of asset values where there are no upwards movements. And we already know for digital type companies that these types of companies are already recognized as being problematic for valuation due to conservatism within the accounting rules. So what's the sort of policy advice that we can put out there? There's essentially three options for standard setters. One, do nothing, just let firms make their own policies. Two, we could amend or clarify the existing standards. Or three, develop a new standalone standard. If we think about doing nothing, then what should happen here? Well, we need to be, or Australia at least, we need to move more to what the US firms are doing and acknowledge the financial risk to holding digital assets. Disclosures, if they remain limited, is going to make it difficult to fully understand. In my opinion, I don't think the status quo appears to be a sustainable position. I think we need to do something more. We could amend the existing standards. Now, in doing this, one thing which would be vital is requiring improvements in disclosures, making sure that firms are very clear about what digital assets they hold and what are the risks that this does embody. Now, by amending existing standards, it's still not entirely clear, however, whether this would ensure consistency in treatment across firms. So if you allow firms the judgment to classify as they like, then it's not necessarily going to solve this issue of consistency and comparability. The third position here is, well, we could issue a new standard here. So acknowledging that digital assets are unique and complex in nature. The technology behind these is not easy to understand. We've got complex instruments here. A new standard may be able to ensure this. It will ensure a consistency across firms and stricter disclosure requirements, and will allow for more consistency in the overall philosophy of the extant standards. And we could be more clearer in how holding gains should be treated, particularly more in line with the underlying purpose. I do understand, however, that there's not a great deal of appetite from standard setters, particularly at the IFRS level, to actually look at developing new standards in this area. They would prefer, from my understanding, to wrap it within the intangibles. Again, I'm not entirely sure that this is the best approach to be taking here. So what is my position that I would advocate for? Well, my position, I apply the duck test here. If it looks like a duck, swims like a duck, quacks like a duck, then it's probably a duck here. By looking at a limited number, and I must admit it's a limited number of firms holding these digital assets, the nature and purpose of these holdings appears to be more consistent to that of a financial instrument. Now, some types of digital assets would appear to meet the definition of a derivative, but not all of them. So a derivative needs to be backed by the underlying financial instrument. If we don't have these underlying items as being a financial instrument to begin with, they're not going to meet a derivative under the current standards. But it would appear that a number of these types, and particularly the tokens, would act in a manner like a derivative, or derivative-like here. So what would a potential solution be? Well, could we extend the definition of derivatives to specifically include cryptocurrencies, or not necessarily derivatives, but financial instruments to include cryptocurrencies, and potentially think about these tokens as being, or extending the definition of derivatives to include token type digital assets. Now, there's a lot of complexity, I understand, that needs to be resolved around this, but it's potentially an option that would appear to be more in line with the purpose of what's being looked at here. And in doing so, we've already got the accounting rules around hedging, which are addressed within this. Now, the trader broker exception within IS2 should still apply in these cases as well. So we should have this carve out for firms involved in the mining and selling of cryptocurrencies. Now, this is just my position, and I'm not there working at the coal front being involved in these, but it's something that I'd like to put out for the debate and stimulate some discussion around this. So just to conclude my thoughts, the technology behind blockchain is complex, as is the nature of these different types of digital assets. There's limited guidance for how firms need to account for these, and the expectation is that the number and size of firms' holdings are going to rapidly increase over time. Now, this poses a substantial hurdle for the standard setters, but it also provides a great opportunity for them to get it right from the start and not wait for practice to evolve and then have it harder to change practice to be more in line with the underlying nature of what we're about here. So thank you for your attention. Very much interested in hearing the thoughts of the fellow panelists and the discussion from the audience as well. Thank you.
Thanks, Andrew, and many thanks for your presentation. I think it sets a good scene for the panel discussion. But first, let me introduce our panel discussants. So first of all, I'd like to introduce Anne Bean. Anne has extensive experience in the practice, academia, and also in the standard setting. She completed a PhD in financial instruments, and before her academic and standard setting career, she was an audit director in KPMG in many different countries. Welcome, Anne. And the next person I'd like to introduce is Greg Vals. Greg Vals has had over 35 years of experience in the industry, including 15 years of experience working at the Australian Taxation Office. He is now the Managing Director of Vals Accountants that provide a range of professional services in accounting and reporting. And in recent years, he had worked on many transactions and policy issues related to the blockchain, crypto, NFT, and other similar items. He's also very active in the market. For example, he's a board member of Blockchain Australia, the Starlights Foundation, Business Advisory Board member of the Australian Business Accounting Expo, and has been shortlisted for Corporate Advisory of the Year for Blockchain Australia 2021. The next person I'd like to introduce is Ram Subramanian. Ram Subramanian, who many of us are familiar with, is the Senior Manager Reporting and Audit Policy within the Policy and Advocacy team at the CPA Australia. He has wide responsibilities, including formulating policy positions on behalf of CPA Australia and its members, and commenting on reporting and audit developments. He also has had extensive experience as senior roles within the public practice sector in the United Kingdom for a number of years, and managing the technical advisory services of a major professional accounting body in the United Kingdom. So welcome everyone to the session. So let's start with the conversation. I'd like to start the conversation with Ram, because Ram has, as you know, he's very active in this space. He's been representing CPA Australia in many ways. And we know that CPA Australia has also been very active on this topic. So the very first question I would like to pose to Ram is that what are the general comments and feedback or concerns about accounting or disclosures of digital assets / cryptocurrencies that you have heard, Ram?
Thank you, Eric. I was actually nodding vigorously whilst Andrew was speaking, particularly right at the end when he called for standard setting activity around this particular topic, because we've been actually, CPA Australia has been calling for research-backed standard setting activity in this space for 2 years now. Of course, in the crypto world, 2 years could be century, because things move so fast in this space. So actually in July 2021, in our submission to EFRAG on their consultation on crypto asset accounting, we recommended that there should be a short-term solution where accounting standards are amended to adequately address the accounting for crypto assets. And in the long term, there is scope for a new accounting standard on crypto asset accounting. Now, I'll come back to some of the feedback we've received on this in a minute. But why did we say what we said in our submission to IFRAG? Now, we can see there are examples in the standard setting space which is taken a similar approach. And the approach that I'm talking about here is something similar to what the IASB has done with IFRS 14 on rate-regulated activities, where they've actually put a placeholder standard whilst they're looking at the issues in much more detail. So there is the potential for something along those lines here, whilst a little bit more research and evidence is collected on what economic activities happen in this space and how they could be converted into accounting. So following the IFRAG submission, we followed it up with a submission to the IASB in late 2022. That was in response to their agenda consultation, where they were looking at standard setting activity for the next 5 years. And we also recommended there that the IASB should undertake research on this topic, followed by standard setting activity that addresses this issue. Now, in putting together our submission to the IASB, we actually went out and surveyed our members before we put in our submission to the IASB. Now, what our members said, now with the IASB agenda consultation, they had picked up a number of topics for consideration as part of their work plan. If I remember correctly, I think they looked at 22 or so projects. And we actually picked 6 of those projects and surveyed our members on them. And one of the projects that we picked to survey our members on was digital assets. And 21% of our members at that time said that there is a potential for standard setting activity around that space. Now, I should correct myself. It wasn't digital assets we surveyed on, it was cryptocurrencies, which is a subset of digital assets. And interestingly enough, we'd actually asked a separate question on intangible assets. And 24% of our members said, yes, there should be a standard setting activity on that as well. Now, we know that the IASB is looking at intangible assets as a potential standard setting activity, starting off with some research, and they have considered the crypto asset world or maybe cryptocurrencies as part of that. But our members actually told us that there is enough evidence here to consider those two things separately. Now, we followed that up, of course, with further submissions to the AASB in response to its own agenda consultation. We've said that this is a topic that needs to be considered further. So we know that digital assets are used for a range of economic activities. So it can be a store of value, a traded commodity, medium to provide access to blockchain-based goods or services, all these things that Andrew's already talked about. Now, current accounting standards probably deal with some of those very well. So where it is a store of value or it's being traded like a commodity, yes, IAS 38/IAS 2 deal with it. But what happens if it has the features of a currency, where it actually is, as Andrew said, it looks like a duck, walks like a duck, must be a duck, right? But we can also understand that the features that you get with financial instruments are probably not the same as the features that you get with crypto assets, which may differ, and that's probably where the standard setting activity needs to be considered a bit more. Now, to the point that some organizations are accepting crypto currencies for trading purposes or for buying goods or services. There's a gas station chain called OTR, which announced last year here in Australia. I think most of their activities are based out of South Australia, but they did actually announce that they will accept cryptocurrencies as part of their when they sell fuel and other things through their retail outlets. We've also heard that both NAB and ANZ are considering issuing some form of stablecoin. And this area is so fast moving. I mean, just this month, February has just started. The UK Treasury has put out a consultation on financial regulation of crypto assets. And they, in fact, I quickly scanned through that consultation and they refer to them as financial products, which is interesting because we don't consider them as financial instruments in many cases for accounting purposes. But in other spheres, especially in the regulatory space, there is a view that they are sort of aligning them with financial products. So there is that regulatory issue that needs to be considered as well, because financial reporting, yes, it's for decision-making purposes for investors when they put money into different businesses, organizations, but there's also the regulatory aspect because financial reporting feeds into governance, which feeds into market confidence. And if there are, I mean, we've heard about OTX a couple of times. If we have major upheavals in the crypto world, what does that do to market confidence? So there is some need for consideration of those kinds of things here. And it's not just about people acquiring or trading in crypto. It's also about those who are issuing crypto and those who are middlemen, so the trading platforms. And there was a story coming out of India where there was a trading platform which was using an assurance practitioner to assure their proof of reserves. Now, there have been some question marks raised around that. So there are issues with middlemen also, trading platforms. And then there's the not-for-profit angle, where we are hearing here in Australia, specifically the Australian Charities and Not-for-Profits Commission. In fact, they have put out guidance on this, where charities can receive donations in the form of crypto. And some charities may invest in crypto, but of course, the risks associated with it need to be considered as well. But the issue around how to manage cryptocurrency-based economic activities is something that is being considered by different regulators, including regulators in the not-for-profit sector. So there's a number of issues that need to be considered here. And the other thing I'd probably mention before I close off is the US Financial Accounting Standards Board has just announced this month again that they voted to approve a consultation on accounting for crypto currencies specifically in the US in a particular way, which probably involves fair value accounting. So there are a few issues there which are developing faster in other countries perhaps than some jurisdictions. So I'll stop there and pass back to you, Eric.
Well, that's really insightful, Ryan. And on top of what you mentioned, last Friday, the Treasury in Australia also released the token mapping consultation paper, which I think is another interesting move that the government has done into this space. So I'd like to hear from Greg now. Greg, you're the preparer of financial statements, and you've been very involved in transactions related to crypto or Bitcoin or similar types of assets. Do you share the similar views that Ram shared? Especially, I think what I'm interested to also hear from you is, are crypto or digital assets widely used in Australia? And what types of them are being commonly used in our jurisdiction?
Thanks, Eric. I agree wholeheartedly with what Graham's saying. Is very much ear to the ground. I mean, we've been in it since 2016, and my practice now is 50% dealing with the Web3. I believe that every Web2 will be looking at how Web3 applies to their businesses, and I would behoove them to do that, because it would be de-risk. It will be a risk to their business if they don't. So we encourage it. We see a lot of people coming in and not understanding what their obligations are from whether it's ASIC, whether it's the tax office, from all industries, and they want to be compliant. They want to understand what their laws are, and we've got to be mindful that this is bigger than Australia. It's world, right? And we should be really mixing, and AASB has a wonderful opportunity to connect with the international world. I was in Austin, Texas last year, in New York. There was 15,000 people at that industry, and they were talking all about the crypto technology around the world. So this thing is getting bigger and bigger. I know we're in a very slump at the moment, but it is inevitably going to rise, and everyone needs to be prepared and ready for it. And some of the things I wanted to talk about was that people have to understand, and in industry, if you're setting standards, etc., and the accounting bodies have to be the leaders in this, and all accountants. And that is about understanding the terminology. I mean, do you know what an airdrops are? Staking, bridging, wrapping, liquidity pools, yield farming, chain splits and airdrops, the foreign currency of it, NFTs, minting, royalties, finance, gaming. These are all the things that we've come across, and we have to apply the law to those, and also the industry. So you need to get your head around it and understand it. All of them have got their own nuances and detail. And we've used vast number of lawyers in the industry, and people have got varying views. So it's really is the government and industry to provide a strong guidance in what we're all trying to do, and sort of get out of the way of these creative people, get everything sorted and allow them to create and make it a better world in that Web3 industry.
Thanks, Greg. What I hear is that there are common types of digital assets in our market, and we should be ready for it. I'm interested to hear from Anne. Anne, you've been around. You're the expert in financial instruments. You did a PhD on it, and you also had done some research on this topic. I'm interested to hear your views in terms of coming again from Ram's point, that is, the accounting issue may not just about the holder's perspective. There may be more issues than that. I'm interested to hear from your perspective. Do you agree with Ram's point, and do you have any other insights you would like to share with us, Anne?
Yeah, sure. I mean, I agree with everything I've heard so far, I think. I got interested in the role of intermediaries, our centralized crypto exchanges, mainly from hearing about FTX on the news. So I decided to have a look at what is going on here in Australia with those types of entities. And I was quite surprised to see we have about 400 of them apparently registered with AUSTRAC for money laundering requirements. So that doesn't mean we're operating 400, but they appear to be registered. We still do have quite a few of them though. And when I took a look at them, most of them are proprietary companies, so they're privately owned. They tend to be small proprietary companies, which means under the ASIC rules, they don't lodge accounts and have them audited. There are a few that consider themselves large proprietary companies where I was able to get their accounts from ASIC. And from that, I saw a great deal of diversity, and I think some issues with the accounting and honestly with the auditing as well, because that goes with the accounting. If the accounting is not settled, then the auditors are going to have trouble as well. I saw problems with recognition. So for example, some of the entities, well, all of them, they hold client money. They also hold clients' cryptocurrencies on their wallets, on their platforms. And so there is a question and a difference in how they account for that. For example, if they hold client cryptocurrencies and they use them in their business, if they are not segregated from the exchange's own cryptocurrencies, should they be recognizing an asset? Okay, normally we would say yes. Normally we would say, well, they should be segregated. But to the extent that they're not, perhaps they should be recognized as an asset. When it comes to client money, I mean, if you're going to trade on one of these exchanges, normally the first thing you do is move some money into your account. Well, that cash money has to go somewhere. So normally the exchange puts it into their bank account. So then the question is that segregated? What can they do with that? I mean, some of the exchanges are saying things like, oh, well, we might convert client money into stable coins for liquidity purposes. And it's not segregated in a separate account, it's mixed in with their money. Well, again, they probably should have an asset reflected. When I look at some of the big listed exchanges that report in the United States, even when they have excellent segregation, or claim they do, after FTX, we don't really know, But even when they have excellent segregation, they still recognize client money as an asset on their balance sheet with a corresponding liability. Okay. And most of the cryptocurrencies, if not all, are held in cold storage offline by third parties, and they're separately insured by those third parties. In some jurisdictions, the custodial function has to be with an authorized custodian, so it's regulated. So we're not seeing that here. Okay. So with sort of this type of thing, with customer assets that perhaps should be recognized and customer cash that perhaps should be recognized, some of these small proprietary companies could potentially really be large private companies that probably should lodge accounts and have them audited. Okay, so there is that issue. There's also the issue here in Australia, of course, that if these companies genuinely do get larger and become large proprietary companies, they have to lodge and they have to prepare accounts in accordance with accounting standards. So on that basis, we might consider that it would be helpful if the AASB was ready for that and had a view on that. I also saw quite a lot of differences in how various earn programs are accounted for. So on a lot of these exchanges, you can put your money, your crypto into the hosted crypto wallet, and you can lend it out for interest, which is paid in tokens. Some of the exchanges, actually you lend your crypto to the exchange, they take possession of it, and then they either keep it to invest on their own account, or they lend it out to a third party, such as a DeFi platform. Now, in that case, they should be showing the asset and the liability. Okay. Some are not. Some are not. And we're talking very big amounts that would certainly push some of the small proprietaries to make them large proprietaries if they recorded that. And therefore, they would have to lodge accounts. So there's really a lot of diversity in practice in terms of then how they recognize and measure, how they measure these assets. I'm seeing quite a few of them are not entirely following the accounting standards. They seem to be trying very hard to achieve fair value through P&L. So for example, with these lending arrangements where they borrow from customers and then lend to a third party, they'll use IAS 2, the commodity broker trader exemption, even though they're not actually buying and selling, they're lending, they're borrowing and lending. But they will use that standard to get fair value through P&L, which is what they want. I've also seen some that say they're using IAS 38 intangibles, but they're putting it through as fair value through P&L. And that option is not available for intangibles. So there does seem to be quite a desire for fair value. I'm also seeing entities that have to change their accounting, not necessarily because their business model has changed, but because the environment has changed. So if you consider companies that, hold Bitcoin or Ether, it's essentially for speculation, really, but they want to show it as fair value through P&L, so they use IAS 2, broker trader exemption, and that works. While there's a fair bit of buying and selling, they can probably push that past the auditors. But last year, for example, we had the big downturn and the big falls in value of crypto, and so some of these entities, they probably don't really want to be selling at the moment. So they tend to stop trading somewhat, and then the auditors say to them, well, you have to change to the intangible standard, right? Because you're no longer trading and no longer qualify for the broker exemption. But really, their business purpose hasn't really changed. And then if prices go up again, which is what we might see, we've started seeing already, what, are they going to change back to commodities again, to IAS 2 again? That would be not good, because you don't really want the accounting to be chopping and changing on a regular basis when nothing has really changed except they're really just speculation, and they really want fair value through P&L. So I don't know. I think I'm moving, the more I see of it and the more I look, the Americans have moved towards fair value through P&L, as Ram said. They're consulting on it, but nobody really thinks there's going to be a lot of disagreement with that. So if they do confirm fair value through P&L, I probably support EFRAG's latest position, which is for a narrow scope amendment to IAS 38. This is short-term, right? Short-term solution. Narrow scope amendment to IAS 38. Allow fair value through P&L just for crypto. Okay? Because it seems to be what they want, and it's not an opportunity for earnings management. It tends, you know, so I would let them have it. And then later, as I think everybody else has said so far, the standard can define, a different standard can come later, a separate standard. So that's kind of where I'm up to on it.
Thanks, Anne. So before I go on, I can see two comments being shared in the Q&A. The first comment, Mark Shine, asking a question, or perhaps it's a comment, is Bitcoin or another cryptocurrency a presentation currency for purpose of AAS3121? I take it as a comment because I think what's implying here is that, you know, in the future, if Bitcoin or other cryptocurrency is going to be normal transactions instruments, then the question is, how do they present it? Do they then use one-to-one? Not sure. David Hardage also made a comment. Even cryptocurrencies can get complicated. Does it include custodial arrangements that you have a receivable from markets? Also, the US definition excludes assets that provide the asset holder with enforceable rights to or claims on underlying goods, services, or other assets. So there's a question on wrapped tokens, wrapped Bitcoin. And I think what the comment here is that, David, it's true that the crypto space is becoming more and more complex, and it's been evolving all the time, and it's going to be developing more in the future. And so possibly the instruments being used will be much more complicated. I would like to now ask a question to the panel. Anne talked about there's some problem, or perhaps in her view, the presentations should be changed. And if I take a step back, right, you know, as I mentioned, there's so many different crypto assets, there's so many different types of tokens, there's so many different types of digital assets, and the point that even, you know, when I did some reading, I was so confused. And the first question that I had in my mind is, look, do we then need to look and be clear on the definition before we go and change the standards? Because there's so many different types of characteristics of each cryptos. Without being clear on what the definition is, then it may be difficult to think about the scope of what the standard setters should work on. So I'd like to pass on to perhaps Andrew first. I'd like to, you know, you presented, you did your presentation. I'd like to hear your views, whether there's a need for the standard setters to think about the definition, and if so, any suggestions or recommendations, Andrew?
So as I talked about, there are different classifications that we have of digital assets. But the point I was trying to make is that these aren't universally accepted, that there are different definitions. Greg then mentioned, rattled off a list of terms. I don't understand what they mean. I'm sure Greg's got another office full of terms as well that we need to get very clear definitions about, and what understanding of what they actually mean. So yes, absolutely, the standard setters need to be very clear about what are the definitions that we're dealing with, what is it that they do mean, and then what are the legal implications of it as well. So it's not just what is the reporting implications, but there's legal implications which are going to be relevant in terms of thinking about things like rights of control. Are there cash flows associated with these? Where do those rights lie? So yes, absolutely. We need to get the definitions right. And going back to the sorts of views that I've heard from the panelists, that at the moment we might need a sort of stopgap within the current standards that we've got, but these sorts of issues around definitions, the meaning of different terminologies, essential to get it right, to get that understanding. And does that belong in a new standard where there's the time allowed and space to actually get to those questions?
Thanks, Andrew. I mean, I just want to reiterate the point that Anne also mentioned about, FASB has, and also Ram also mentioned that FASB had done work on this area, and they have been specifically looking at cryptocurrency, right? Not ABCD types of other digital assets, and so tied with the definitions views, Andrew, I'd like to ask Ram, your views on, whether there are specific types of digital assets that standard setters should look at, or we shouldn't be going into that space yet. Maybe just monitor the development of all different types of digital assets before going too far. I like to hear your perspective on this, Ram.
Thanks, Eric. Look, I mean, I think we've covered quite a few of the issues already and touched on the principal versus agent issues, the issues around issuers and how they account for crypto. And then you've also touched on the cryptocurrency versus broader crypto asset scenarios. And of course, FASB is only looking at cryptocurrencies. Now, one of the questions here is, if we are going to ask for standard setting activity, of course, we've heard the IASB say that, look, from their perspective, when they're looking at economic activity in the capital market space, which is what they are primarily interested in, the level of activity that they perceive is not significant. But one of the questions we have is, when will it turn significant and it becomes something that has to be addressed immediately or sooner? So if you think about how standard setting progresses, generally standard setting happens when there is a need for standard setting. And I think here is an opportunity to actually address it in advance of it becoming an economic activity that doesn't have adequate accounting requirements. So I was just reading an article yesterday, and the funny thing is, I don't need to do any research on this topic. I just need to look at my news feeds, and there's plenty of stuff that I can pick up and talk to. And the one that I probably want to quickly mention is, I read an article in the BBC yesterday that the Bank of England is planning to do a CBDC issue by 2025. And so that article also explores, why is a CBDC different from normal fiat currency? Because normal fiat currency is still digital. I mean, the majority of the currency is not in paper notes or coins. Majority of the currency is actually in digital form. So how is it different to that? So the article actually says, look, there are features of digital CBDCs which allow for certain things to happen, where you can actually track the data surrounding the use of a digital currency differently to what you would do with a fiat currency. So you can actually, that data that is generated out of this particular sphere can be very useful, not only for regulatory purposes, but also for retailers, wholesalers, the whole gamut. Yeah, we are actually, this is early days, but CP Australia, we're actually looking at mainland China, which has already issued a digital currency, and what kind of usage is being seen in that space. So I think there is a need here to consider all these issues, and I personally think there should be at least a research activity undertaken at the IASB level, which considers some of these issues.
Thanks, Ram. I'd like to now ask Greg the next question. So, after hearing all the thoughts from Ram, Andrew, and I'm wondering, as you would like to, as you communicate with the investors quite often, I'd like to hear that whether investors ask for information about crypto and what information they would want preparers to provide information about crypto?
Yeah, good question, Eric. I think that, well, firstly, there's two formats. There's the investor that's investing in cryptocurrency. They have trouble trying to keep up with recording what they need to keep for the ATO and regulatory bodies. So they need us to have a look at all the nuances from the on-ramping and off-ramping and the software required. We also have people that have crypto businesses that need to understand and the biggest problem that we have for them is that when they receive the income, and if it's treated as income, whether it's trading stock or CGT event, they have to, if they leave it in there and their tax obligation is hit at that point, they either need to, we encourage that they put away their tax obligations and they put in either in a stable coin that's backed, so that they cannot, and what we find that they don't listen to our, most listen to us. Those that don't find themselves that there's a big drop in their crypto assets, and they find they've got no money to meet their commitments. So the volatility of that is the biggest thing that we see. We see that people, we've had exchanges come to us and ask us to help us for what their responsibility and obligations are, so to their clients. So we make sure that they provide a proper tax report for them as best they can, and it's still on the onus of the client to come to us for assistance. But it's all of that nuances that clients have come to us for an understanding.
Thanks, Greg. That's really helpful to know. Okay, so we had spent the last more than 30 minutes to discuss all these issues. Now, to wrap up, I would like to ask everyone's views on, given that crypto is still evolving and developing, should standard setters do nothing, wait until the market is more mature? Second, monitoring, that is, keep monitoring the developments and changes in the markets, and perhaps get feedback from stakeholders at the same time, or do something. Now, we don't know what that something is. So if you are going to recommend to do something, perhaps would be nice that you can give us some recommendations on the practical action things that we can do. So perhaps, Ram, do you want to start first?
Yeah, thank you, Eric. Look, I mean, we've already called for standard setting, or at least research-based standard setting in this space. So we've done that a couple of years back. So I think that position still remains the same from our perspective. We can see that, the impact on the capital market space could be minimal at this stage, but I don't think you can rest on that particular point and say nothing should be done, because nothing's happening significantly in the capital market space. I think this is taking off in a big way. So the question is, what standard setting activity? I think Anne suggested perhaps IAS 38 could be amended to reflect fair value accounting for crypto assets. That could be a starting point. But monitoring itself is not enough in my view. I think monitoring only allows you to just look at it and say, okay, that's happening, what next? And if you think about the monitoring itself, the activities are so fast paced. It's very, very actually quite hard to keep track of things in this space. So I think the token mapping exercise that you mentioned that Australian Treasury is doing is quite an important exercise. That will hopefully capture some of the economic fact patterns that you're looking for in this space. So that's quite important. What are the economic fact patterns you're looking for? What are the ones that are already being dealt with under existing accounting standards? And I think you can argue that some of the crypto assets can be accounted for under existing standards. And what are the ones that aren't being properly dealt with, and what should be done to deal with those properly? And I think the more we look at some of these staking and the point that David actually mentioned in the chat, they all look like derivatives. I mean, if you think about financial instruments, we are sort of used to derivatives in the financial instruments, and Anne probably knows quite a bit about that. But some of these do have the characteristics of what you would normally consider derivatives in the financial instrument space. So I think there is something here that needs to be considered. I think Andrew mentioned in his presentation right at the beginning, $3 trillion. We're not talking about small chump change here. We're talking about big amounts of money, and the movement in those markets is significant too. So what was last year's value is not necessarily this year. Actually, it isn't this year's value. We know that for a fact because the values have dropped significantly. So as a regulatory function, I think financial reporting should really give some thought to some of these challenges.
Thanks, Ram. And do you share the similar thoughts as Ram?
Yes, I do. Not trying to make more work for myself, obviously, but no, I don't think here in Australia we can really afford to wait. I've mentioned crypto exchanges that hold billions of dollars of Australians' money that are not preparing accounts, and the money is not recognised. It's often not insured. I mean, that's partly a regulatory issue, not just an accounting issue, but there are accounting issues that I've described. And then they could become large proprietary companies in due course, and then they will need to prepare financial statements and will need to be audited. And then, as David Hardage has reminded us, as Ram said in the chat, you know, we've got self-managed super funds that also have to prepare accounts and be audited, and they hold crypto. Maybe not very complicated crypto, but nonetheless, they are buying it. And then there are ordinary managed funds and other types of entities. So I don't think we can afford to just wait until there is a critical mass and then we're not ready. That would be my view. So I think outreach, we need outreach. I would love to talk to people who don't necessarily prepare accounts, people with proprietary companies and in the private sector, and get their views, because I don't think we have seen that yet.
Thanks, Anne. I'm conscious of time. Andrew and Greg, maybe Greg, do you want to provide your insights now?
I agree with both of you, and I think that we've got to look at what the international, we're going to be left behind if we don't do something, and we need to be across it, and we need to be across it with all the other government bodies as well. So we're all singing from the same hymn book, and we understand a consistency, and then we need to be a great leader in the world on this, otherwise we will be left behind. And so that's my short point.
Thanks, Greg. Andrew, I assume you have the same view or different views?
I think my view is very clear from the presentation, and I'm conscious, or I remember a conversation I had with the chair of the AASB, Keith Kendall, a couple of years ago, I think it was, that the role of academics is to think about these things and have the report when the AASB needs it, they can pull it off the shelf. This is the area that we desperately need that, in my opinion. Yes, it mightn't be significant at this point in time for listed companies. As David Hardage has mentioned, it's not just listed companies that are using this, as Anne mentioned as well. There's a lot of areas. So yes, in the short term, maybe a stopgap, but we need to get it right. And the AASB, I think, is in a great opportunity not to waste this opportunity, to get on the front foot, think about it while we still have time. And when it does become a significant issue, to say, AASB, we've got the solution here, we've got on the table for you right now. So the AASB, I think, is in a great position to be a world leader in this area.
Thanks, Andrew. So as mentioned, the AASB Research Centre is going to do a series of outreach. We'd like to talk to people about your views on digital assets. So again, thank you for your participation to the webinar today. I also like to thank CAA and ZACT and CPA Australia supports for this session. And most importantly, I'd like to thank Anne, Andrew, Greg, and Ram for providing us with your thoughts and insights to make this event a success. So the next dialogue series session will be held in May. It will be a joint session with the Auditing and Assurance Standards Board to talk about issues related to going concern disclosures. So that will be a very exciting event as well. Thank you, everyone, and have a good evening.